Hello, everybody, and thank you for tuning in. Can you believe it's July 20th? We're on the second half of summer. Enjoy it, folks. It's moving and flying by fast. I think you're going to really, truly enjoy today's presentation. It's our second quarter 2022 market and economic update, and we have a great panel that will be presenting. If I think of the dynamic team that I'm surrounded by. Today, I have John Millay, Marty Shields, Harmony Wagner, all wealth advisors, all play such an important role in the firm. And if I were to add up the years that they've been surrounding me with their just amazing talent, it's been about 30 years. So before we get into the presentation, just a couple of good news items that I'd like to share with you. One, behind the scenes, we have David Clark, who doesn't get much airtime, and Samantha Macy today, who's one of our associate wealth advisors. And the good news for Samantha is she took her CFP, Certified Financial Planner exam, and I can assure you this is no easy exam to pass, and she was successful. So our team now includes 5 CFPs, 4 CPAs, and another bit of good news, which you'll be getting an email soon, but as long as you're taking time out of your day today, I'd like to share with you. Ryan kind of took a break from the firm. He relocated to Boston with his family and took some time to get settled in. And now he's settled in, moved into his new home last weekend. And Ryan has rejoined the firm and is back with us. So we'll be sending an email out on that. So a couple great, nice, positive things that happened today I wanted to share with you. So now, without any further ado, let's get started with our presentation. We're going through one crazy year so far, and I can't begin to tell you. Sam did the radio about a month or so ago, and as she eloquently pointed out to the listening audience, market corrections are never comfortable, and I've stolen her line many times because they are never comfortable. And for me, believe me, as much as I understand market corrections, bear markets, and recessions, I don't like them. I don't ever like it when clients are sliding backwards a little bit, losing a little value in their portfolio, but I understand it along with my team. And this is when I always remind my team, we get paid to take the emotion out of the decision-making process. And we've gone out of our way to communicate with you over the last several months. And hopefully that's helped, especially with these monthly webinars that we do, to just kind of help you understand what's going on. Not that we always have the right answers, but I can assure you we are being very active with managing the portfolio and having the portfolio, be managed by us, that you are in good hands, not to, let you forget, but 100% of my family's money, along with all of my advisors, are managed just like your money is managed. And that's something that there's not many firms out there that can say that. So these are trying times. We are in a, depending on how you want to look at it, bear market, let's say. The markets are off about 20% from their high. NASDAQ off about 30% from its high. Bonds are actually off 10% from their high. And we've been down this road before. As I like to remind investors, if you think back 2 years, 4 months ago, and back then the S&P was down 34% in a few short weeks, it seems like a blip on the radar screen. If you go back 15 years ago during the financial crisis, the Great Recession, once again, the S&P was down 50%. It seems like a blip on the radar screen. So the feelings that we're getting now with the markets being down, and believe me, after yesterday and today being 2 great stellar days in the markets, the S&P is probably only down about 16% now from the high. And it only takes a little bit of good news and a few good days for that market to turn around. And there's a lot of bad news built into the market, as you'll see in today's presentation. So today we're going to talk about the overall market overview, which I kind of just shed some light on, the economic outlook, challenges for corporate profits, interest rates and inflation, reasons for optimism, and how to be a good long-term investor. The next slide, if I'm looking at this, inflation is in the headlines, along with, we're still dealing with COVID. lingering on, the supply chains in China and other parts of the world being affected by COVID, but especially in China because of the lockdowns. And anybody who's going to buy anything, more than likely, you're not getting it like you used to. It's not being overnighted to you because they just can't make them. So we have that. We have the invasion of Russia with Ukraine and inflation. And that's what's on everybody's mind. When you think of inflation, and 9.1% was the reading last week for the CPI. And I like to point out that that was a scary number, 40-year high. We thought the month before at 8.6% was high, but 9.1 was even higher. But since then, and this is not built into the CPI index, you have gasoline down about 50 cents a gallon. You have copper over the last 3 months down about 30%, and so many other commodities down about 20%. So maybe, just maybe, you have a lot of bad news behind us, and maybe things won't be as bad. Inflation is a moving target, and the Fed will be hiking interest rates when they meet next week. We're not sure if it'll be 0.5%, 0.75%, or 1%. They're trying to make up ground because they really should have been behind the 8 ball a year ago, and they were a little late to this party, and we'll get into that more. But inflation is on everybody's mind, and as you can see from this cartoon, it doesn't look scary, but what's behind the scenes, and inflation is a moving target. We'll see as we move on. I'm in the camp that I'm more optimistic that if we do go into a recession, and we may not, if we do, I don't think it'll be as deep and severe as some people are proposing. Real quick, I kind of gave you the overview of the markets. This kind of just breaks it down by different indexes, but for the most part, the S&P, as we sit here today, year to date, down about 16%. NASDAQ is probably down about 25%. It was down 33% at one point, so it's gained 8%, and bonds are down about 10%. Commodities are the only thing that have done well year to date, but commodities have actually lost some of their luster in the most recent, couple weeks or so. So let's get into the presentation. And, before we do, as you know, we are overweight U.S. equities, with the sectors being technology, energy, healthcare, and consumer staples. We took a defensive stance as we've been being tactical with the portfolios over the last few months, and you've seen us make trades in the portfolio. We're always looking ahead, learning from the past. We still have absolutely no international equities in the portfolio. We don't own any bonds or high yield debt. We just feel that they're not a place we want to be invested in. One of the greatest decisions we made back last fall was to kind of underweight bonds and then get out of bonds completely. People who had bonds in the portfolio to soften the blow from volatility, but year to date, after bonds have come off a 40-year bull market, bonds are actually down almost as much as stocks, and we don't think that's going to change course anytime too soon. So we've been investing in alternative assets. So without any further ado, let me hand it off to John Millay, who will take the next section.
Thank you, Steve, and good afternoon, everyone. Hope you're enjoying today's webinar. So I'm going to cover, the topic of, we are in a strong economy, but there are signs, right? And there's signs things are weakening, and we've got to pay attention to those signs. So I'm going to go through a series of slides that, highlight some of the things that we're looking at. We always start with a little cartoon, and so this is one where, we're hearing the growling, right? We're hearing the grumbling, and, we have to pay attention to what the source of that is, or we're going to become lunch, and we don't want to become lunch for somebody. So we're going to pay attention to what's causing that grumbling. And so, the consumer has been the bright spot of this economy, right? And consumer spending is the single most important driving force of the U.S. economy. And the good news is it's been healthy and it's been increasing, which is great. But I will say we are seeing a shift, right? Consumer spending is shifting, and we're seeing consumers be more selective on where they're spending. So we're seeing less on durables, particularly appliances is an area where there's been a great reduction, but we're seeing more on services, travel, and leisure, and apparel. And we're starting to see the impact of demand destruction as prices have increased so much, consumers have fled to other categories. And, in Q1, we saw that it impacted earnings, right? We saw retailers who had large inventories who had to do shifts really to adjust to consumer spending. This chart, what we're showing is, consumers still have a strong, healthy balance sheet, which bodes well. And so this particular chart shows household debt service ratio, so debt payments as a percentage of their disposable income. And certainly showing we're in very positive territory. Q2 of this year, we're 9.5%, versus in the 07, 08, it was almost 13. So highly leveraged consumer back then. Here we've got consumers who've been disciplined, right? And so not over leveraged. And this bodes well for future spending, right? It shows that there's ability to spend more in the future, right? So which is a good sign. But we are seeing some upticks in this, so a number we have to keep an eye on. The other thing, consumer related, is the housing market. We've had a red hot housing market, and naturally we start making comparisons to other housing bubbles and in comparison to the Great Recession of 08. And, comparison is it the same or not? And from a mortgage origination point of view, very different, right? So this shows mortgage originations by credit score, with green being very high credit scores, blue being middle, and dark being the lowest. And so certainly looking at, 2020 to 2022, just look at the significant originations with high credit score. So, consumers, very healthy balance sheet. Contrast that to 06, 07, kind of the buildup of the Great Recession, and look how significant the blue and even the gray area is showing, consumers who have less capacity for debt, taking on, debt, which stressed the financial system, as we all know. And so good news here is, from a bank perspective, lenders are they're in a good position to repay this debt. Healthy credit scores, healthy consumer. So very different market than where we're back in 08, 07. Moving to the next slide, the labor market has been strong, but we are seeing some signs that it may be topping out. And so this chart in particular, shows the unemployed. The blue line is the unemployed individuals, and the yellow line is job openings. So, healthy market, showing essentially for every one unemployed individual, there's 2 job openings, which, super tight labor market. Now we are again starting to see some signs that may be a topping, right? So we're starting to see an uptick in unemployment claims, and the labor participation rate has been declining, and quite frankly has been declining steadily since 2000, and that's significant as we're figuring out how to deal with this tight labor market. The labor participation rate will impact that. So here it's been a strong market, continuing to be strong. Unemployment still 3.6%, so very strong numbers, but certainly some signs that things may be changing. So we have to keep our eye on that. The next chart, copper prices, and it's interesting. Commodities have certainly been doing well, but copper is one of those commodities where economies look at it as an indicator of the economy and whether there's risk of recession. And this is certainly, I'll say flashing red. And it's interesting. Copper has proven over centuries to be a pro-cyclical commodity. Which means that when prices go up, so typically goes the economy. And conversely, when copper prices start to fall, it typically means the economy's headed in that same direction. So here we're seeing a significant run up in copper prices, and we're starting to see some decline. So this is definitely one of those signs where showing that the economy may be starting to slow down and decline. So again, a leading indicator, but something we have to have our eyes on and see how it's going. The next chart is showing manufacturing and services PMI, which is the Purchasing Managers Index. And so, this index is, kind of determines, market conditions, whether they're expanding or contracting from the perspective of purchasing managers. And so this is both manufacturing and services. And so the key line here is the index line at 50, right? So anything above 50 is considered in an expansion territory, and below 50 is things are contracting. And when you see an increasing line above 50, it just means that the level of expansion is increasing. What we're seeing now is a decline. Now we're still above 50, so we're still in expansion territory, but we're seeing a slowdown of that expansion, and we're going towards that 50 line, which would show contraction. So this, shows we're still expanding, but definitely heading in an area where we may be going into contraction territory. So again, from the perspective of purchasing managers, definitely seeing a softening in this area. So the general theme is from that category before is really still strong economy, but there's signs out there, right? Signs that things are slowing. We have to keep our eyes on that. The next category we're going to look at is, the challenge for corporate profits. So as things slow down, this is an area where there's going to be challenges, and we're going to kind of talk about some of those challenges right now. First has been, area is operating margin. So we're seeing operating margin at risk, primarily because of the impacts of inflation and the rising dollar. And so this chart shows in the blue increase in the S&P 500. And as you can see, driven nicely by a growth in operating margin, right? That's what we want to see. We want to see operating margin growth, which leads to profitability. So healthy run up of S&P 500 price with the operating margin. Now we're starting to see some margin contraction, right? And so largely driven by increased operating costs, which, labor cost component of that, energy, and just overall other impacts of inflation. So as we're seeing operating margin decline, that's going to be a concern, right? It is as the margins declining, how that will overall impact earnings. We talked about the U.S. dollar, and so, U.S. dollar is all-time strength. We look at the euro; it's the highest been in 20 years. We reached parity for a moment, and then it's just strong dollar. And typically we think as a consumer that's a positive, right? If you're traveling to Europe and spending dollars, that is a positive. But if you're a U.S. company with foreign operations, that's actually a negative. That actually hurts revenue and earnings. Really have less power because of the conversion. And we're starting to see this impact earnings. And, some of the recent earnings calls are citing that. So Johnson & Johnson in their recent guidance, they reduced their sales guidance for the remainder of the year because of the strong dollar. Actually, for 2022, they're indicating that their sales are going to be down about $4 billion solely because of the impact of foreign exchange. And they're expecting about a 65-cent decrease in EPS because of that. Netflix, who just came out with very strong earnings, did cite, the unprecedented appreciation of the U.S. dollar impacting their earnings going forward. They have 60% of their revenue comes from outside of the U.S., and the sudden dramatic swings in foreign currency is impacting their profitability. So they're citing that in their guidance. So clearly, the strength of the U.S. dollar is starting to impact corporate earnings. The next, area we're looking at is the producer price index, and it is continuing to increase. And so the PPI, tracks what companies pay to make their products, right? And so as you can see, a solid number up until about 2020. Now we're seeing increase, right? So as the costs are increasing, the cost to produce these products is being reflected in this index. Now, if you can increase your sales or your pricing, right, then you can absorb those cost increases and it won't have margin impact. But quite frankly, we're seeing a lot of companies don't have the ability. There will be demand destruction if they raise their prices too much. So this is an area where if a company's not able to increase their prices, then this increase in their price to produce will impact their margin going forward. So an area we're looking at, and certainly one of the concerns of the potential margin contraction as we move forward. At this point, I'm going to turn it over to Marty for the next segment of our presentation.
Thank you, John. I hope everybody's doing well on this nice sunny summer afternoon. What I first want to talk about is inflation and interest rates, because those two elements are so important to where this economy is going to go. This chart shows you the Federal Reserve funds rate, and this is the rate that the Federal Reserve controls for their lending to banks overnight. It's a very short-term interest rate, and what is highlighted there in the red circle is the current rate of 1.63%. That is after they raised their rate by 0.75% in June. The likely amount that they're going to raise it in July is probably another 0.75%. And then we'll have to see in August and September and October where they go. But the expectation is it will end up somewhere around 3.25% to 3.4%, which is shown in the dotted graph above. And so what you'll see at that point is it'll probably start to plateau, and expectations that they'll pause for a bit there. But the name of the game here as we go forward is, where does inflation go? And we've heard the term transitory inflation. That was all last year. And now we're hearing the term peak inflation. Peak inflation was supposed to occur in March, but as Steve mentioned, we saw a print of 9.1% for CPI in last month. So we really need to start to see that come down. And as was discussed, there's a number of factors that can start bringing that down. So we'll see how that plays out, and that will drive the decision. When we look at more long-term rates, that's actually, long-term interest rates are driven by the market. And the benchmark rate that everybody looks at is the 10-year US Treasury rate. Now in June, we hit 3.5%, and you can see we've come down from that level a certain amount, and we may or have already plateaued in that. So that's the interesting thing to realize, which is the Federal Reserve may continue to increase short-term rates, but when we look at long-term rates, we actually may have already plateaued with that. And what that means is, we've talked about this on many of our calls and webinars, is that you may start to see the yield curve, which is the interest rate you can receive at different maturity levels, start to invert. So right now, if you look at the 10-year and the 2-year yields for the Treasury, it's already inverted, and that's highlighted in the red circle. So as we've discussed, when the yield curve starts to invert, that indicates that the market is expecting the economy to slow. And the real crux is really more the 3-month and the 10-year. And as I just discussed, you can imagine if the 10-year is around 3% and you have a federal funds rate, which is a very short rate, that could be at 3.25 in the next 3 to 4 months, the likelihood of having an inverted 2 and 10-year and a 3-month and 10-year is pretty high. So that is a pretty strong indicator that we're probably going to see the economy slow down from where we are now. And I love this graph because it really shows you what is a big factor as to what got us into this situation. So this is the money supply, which, just as the name indicates, is the amount of money that is in the economy. This supply is really controlled by the Federal Reserve, and they can increase or decrease the amount of money that is in there. It could also be based on the federal government spending. And what you've seen is, if you look back since the early 60s, it really runs in a range. And so the yellow line is the actual money supply. The blue line is the real money supply. So that's the money supply less inflation. And again, you can see that it's been in a range, except for in March of 2020, it took off. So, you've had the supply issues that has been discussed here, both with the war in Ukraine and also the supply chain issues with China. But really, a big part of the inflation factor has been the amount of liquidity and just dollars out there that put by the federal government. And that has caused the money supply really to sharply increase. But what you also know is it has sharply decreased as well. So that sharp decline is what is going to potentially slow down demand and lower inflation. I think this chart is so compelling. So for clients who have been with us for a while, we show this chart on the stock side just to talk about intra-year volatility. And that is what you see here is that's the red numbers, red dots. And then the gray bar is the performance for the year. But this chart is not stocks. This is bond performance since the mid to early 70s. And how dramatic is it that year to date, we were down 13% with the Barclays Ag Bond Index. Currently, we're down around 10%. And you can see as you look back, there's really nothing close to that at all of the last 50 years. So as Steve mentioned, we've really been underweight to having no bond allocation in our client portfolios, and has been very beneficial. And this helps to illustrate how dramatic this year has been in the bond market. And even as we look at, potentially if we want to add bonds into the portfolio as we go forward, the one real issue we have is, the yield or interest rate you can get from a bond, which has moved up from where it was, and it's shown in this graph as the blue line. But then there's what's called the real yield, which is the gray line. And what you can see is that gray line, the real yield, is still negative, right? So even if you're getting a yield of, let's say, 2.5% on a 10-year U.S. Treasury, so you're locking in for 10 years at that rate, with inflation, even if it comes down dramatically from where it is, that yield is going to be negative. So even at this point, adding bonds, and certainly long-term bonds to the portfolio, is less advantageous than it might be a little bit farther down the road. But as we go through these presentations, we always try to highlight reasons for optimism. I always say you cannot be an equity investor without having some element of optimism in your personality. And I think this chart really helps identify what we've seen for the past 6 months. So the gray bar is showing you earnings growth that has occurred. And year to date, we've actually had earnings growth. So even though the market's down 20+%, as we were in June, the actual earnings that companies have seen have actually increased. So as we've talked about many times, the market is always forward-looking. So it's less concerned about what the current earnings growth is, but what is the future or planned earnings growth. And what has occurred year to date is shown with the blue line, and that's a decline in the multiples or the valuations for stock. So you can see that it's declined by 27%. So we started the year with a PE ratio of forward earnings for 12 months around 22, and now we're down to 15.9. So a real stark change in the valuations of companies. And what that does is it really sets us up in a better spot for future performance. So the graph on the left looks at where we stood with valuations on December 31st, 2020. And it looks at how we stood at that point versus other times historically. And you can see that with a PE ratio of 22.3, the likelihood of strong performance over for a 5-year period was pretty low. You're really talking about almost 0%. Whereas now with a PE ratio of 15.9, you're really in a better spot for strong performance over the next 5 years. The other element is, we're talking about the S&P 500 and how are companies valued based on their earnings and their balance sheet. I think this chart is very telling. So this says for the S&P 500, there are 12% of the companies in the S&P 500 that are actually valued. The entire company is valued less than their short-term investments in cash. So that really is a telling sign that there are a number of companies out there that are tremendously undervalued versus what their balance sheet holds. And again, that is a good sign for more of a long-term growth opportunities in the market. Now I'm going to hand it off to my colleague, Harmony Wagner, who's going to highlight how to be a good long-term investor.
Thank you, Marty. Steve, John, and Marty have all shared a lot of great points regarding kind of the current economic environment, things that we're keeping an eye on, and what those things say about the future. I'd like to close out the presentation today by kind of zooming out and talking about the importance of long-term investing. It's the message that we preach to our clients year in, year out, in good markets and bad ones. And it is so important to kind of maintain that mindset in order to be able to accept and embrace the risk-reward proposition that the markets offer. So let's go through a few informational slides just talking about being a long-term investor and what that means. This first one is kind of setting an expectation for what is normal for the stock market and what typically happens in terms of swings in the market in any given year. This shows the every year since 1980 in the markets for the S&P 500. This gray bar on the top shows where the market ended for that calendar year, but that red dot, which is present for every year since 1980, and I'm sure before that as well, shows the furthest that the stock market declined during that year. And you can see that in every year, there was a point that it was negative for the year. And this just kind of sets the expectation that it's very normal to see dramatic swings on a yearly basis. That it's part of what you accept as for the long-term growth proposition, is you accept that volatility, and you have to be prepared to accept it. So what we're experiencing now, you can see that year to date on the far right column. The furthest that it's hit so far this year was down 24%. Right now we're down about 21%. And that's very normal. That's well within the range of normal. So, no cause for concern, and, doesn't mean that things will not improve even this year or certainly going forward. Next, we'll talk about bear market drawdown versus duration. And this is really comparing bear markets that are in recessionary periods versus times that a bear market was not associated with a recession. The blue dots on the graph you can see are the non-recessionary bears, and the red dots are the recessionary bears. And the important thing to notice here is that the percentage drawdown between those two categories is not significantly different. So with a bear market without a recession, the average drawdown was just under 29%. And for a recessionary bear market, it was 32%. So only about a 3% change, which is not, significant. What we do see as a differentiating factor is the average duration. And when a bear market was associated with a recession, it typically lasted much longer. The average was 374 days compared to 218 days with a non-recessionary bear market. So, a lot of people are wondering how much worse will it get from here if the US economy does go into a recession. And, the data would suggest that it may not get dramatically worse from here, but that it would contribute to potentially and probably a longer duration of the bear market. This is a slide that we've shown many times, and I'll just kind of review it briefly again, and we'll make the slides available after the presentation to anyone who wants to review in more depth. But this just shows the performance of stocks, bonds, and a blended 50-50 portfolio over time. Green being stocks, the blue section being bonds, and the gray section being a 50-50 portfolio. And you can see that over a one-year period, of course, as you'd probably expect, stocks are the most volatile. But as we go out 5, 10, and 20-year rolling periods, this is all those periods since the year 1950. You can see that over time, stocks truly are the best asset class to be invested in for growth. And actually, over the 20-year period, you can actually see that they outperform both of those other options, the bonds or the 50-50 portfolio. So, again, you have to be able to accept and embrace yourself for more volatility in the short term, as the one-year section shows. But over time, stocks are a great place to be invested for that long-term growth. And this chart suggests something similar. This shows asset class returns of different asset classes. We also have the S&P 500 here in green, and the average investor in orange, which are the two I'd like to highlight here. But it shows some other asset classes as well for kind of comparison's sake. But it shows the 20-year annualized returns. And you can see that over that 20-year period of 2002 to 2021, the annualized average return for the S&P 500 was 9.5%. However, the average investor in orange, which is measured by inflows and outflows of mutual funds, only earned 3.6% annually. Now, why the difference? Data would suggest that even though most people know the old adage to buy low and sell high, that most people don't do that, and the emotions of being invested get to them. And so instead, they in fact end up doing often just the opposite. When things look scary, that's when they sell out of the markets, and when things are looking good, and that's when they buy in at a higher price point. So, it just speaks to the value of, working with an advisor to remove the emotional element from investing, and to truly buying into and believing in the stock market over time, looking at the historical evidence and being able to accept that and be optimistic about that for the future in order to withstand the downturns. The last slide that I'll discuss today is here we have highlighted that this time is not different. And, if I had $1 for every time someone said, well, this time is different, and wanted to, maybe make a dramatic change that wasn't in their best interest, it always feels different in terms of the circumstances that may lead up to a bear market or recession, whether it was the pandemic or the financial crisis, or, you name any correction or recession in the stock market's history. The factors that led up to it may be slightly different, but the outcome is going to be the same. It will recover as it always has. We've seen the stock stock market recover from so many different types of events, financial, global, political, and others. So, although it may feel different in, the factors or the circumstantial items that surround it, I would encourage each person to remember that this time is not different in terms of our long-term outlook. And, the long-term outlook on being invested is still much better than the alternative of, keeping the cash under your mattress. Thank you so much to everyone who tuned in today. We'll be sending out a recording for anyone who wants to look at it in more depth or rewatch anything. But I just wanted to thank everyone for their time. If you have any concerns, if you're being kept up at night, you're worried about peace of mind, please don't let that go on. Please give us a call. One of our advisors would love to speak with you and be of service and kind of help you. Thank you again for your time, and have a great rest of your day.